Let's move to property with spring. It is, of course, historically the active season to buy, and also to sell as well. Anthony Lundale from Equilibria Finance is here to share his views on what spring selling season will look like this year. Anthony, great to talk to you again. It's interesting, isn't it? Because this is all in the background, of course, of what's going on with COVID. That's particularly affecting the markets in New South Wales and Victoria, where we have lockdowns. That also is affecting listings at the moment. What are you seeing?
Yeah, g'day, Andrew. Nice to be here again, mate. You're absolutely right. We have seen through this lockdown period a drop in listings of about 26%. And spring is traditionally when new listings are up. Historically, listings are up about 15.7% in spring. And Andrew, with some of the talk of lockdowns easing, even as recently as today in New South Wales, we've spoken to a lot of real estate agents. They've essentially got sellers who, in layman's term, have been sandbagging. They're waiting for these lockdowns to restrict. And they're even seeing levels about 10% higher than the historical spring selling season, which, as I said, is about 15.7% higher. So I think the tailwinds are there for a busy spring, albeit I think it's going to be a little bit of a delay tied in with the lockdowns and the restrictions easing. So it might be we're looking at late October, November through to in the new year, but I think the tailwinds are there with stock ready to come on the market, buyers ready to buy, low interest rates, as well as there are elevated savings rates with a lot of households ready to go. So I think the tailwinds are there for a busy spring. It might be it just starts a little bit later than normal.
All right, maybe a pre-Christmas rush then, depending on, of course, when those lockdowns are listed. So, Anthony, given listings where they're at the moment, tight supply, what's that doing to prices?
Prices have the 12 months to August risen nationally 18.4%, but we're seeing a slowing growth. August, we started to see a slow in the actual growth rate. And what we tend to see in spring is, while we see an uplift in stock, we see about a 6% growth in buyer activity, which is lower than the seller activity. So I think what we're going to see is we're going to see some increased stock. Buyers are ready to go, but I think the rate of growth is going to continue to slow. So that's a good environment for buyers, but sellers are also taking advantage of the rises that have been gained over the last 12 months. So I think we got some tailwinds there for buyers and for sellers.
All right, if we break this down into segments, what are you seeing at the moment? Houses versus units, owner-occupiers, investors.
Yeah, probably one thing we have seen is a pause in the big city areas, the Sydney and Melbourne. In terms of what we're seeing, houses are still outperforming units. We saw a real drop in units, particularly in the city areas when COVID hit. That was largely due to the shutdown of the borders. Units are coming back into the market, but some of them are in different areas, regional areas, out-of-town areas. In terms of owner-occupiers and investors, look, to be frank, a lot of this activity and a lot of what we're expecting through spring is still owner-occupier driven. We're seeing some of the first home buyers starting to get a little bit priced out of the market, but there's a lot of upgraders looking at upgrading. Investor behaviour is changing. They're looking at different opportunities in different regions. So they're coming back into the market, but they're being very, very strategic about their purchases. So for investors, they're being patient. They're cashed up. They're ready to go. They might have used equity in existing properties. They are coming back in the market, but owner-occupiers are still dominating the markets at the moment, particularly established housing, particularly in the largest cities and some of the regions.
And how's this translating as far as loan growth is concerned?
Yeah, loan growth and credit growth is probably at historical high levels. I think I read in some of that CoreLogic data we're at 32-year high in terms of some of the actual credit growth. And I know the regulator and the RBA mentioned as recently as their meeting on Tuesday that they're really keeping an eye on household debt and debt to income ratios as we have this growth rate and as the demand for credit keeps on increasing. Albeit, they're also keeping a good eye on lending standards. And interestingly, we're seeing a lot of the banks, and I use this term somewhat hesitantly, but self-regulating. They're keeping a real eye on their loan-to-value ratios, their low deposit loans. They're keeping a really close eye on their assessment ratios, and they're doing some of those changes outside the scope of regulator intervention. And I think that's a good sign, where there's some self-regulation coming into the market, which is keeping some of those debt-to-income ratios, those assessment rates at levels that are impacting borrowing, but probably impacting borrowings in a good way.
Anthony, thanks for giving us the lay of the land. Thanks for joining us.
No worries, Andrew. Good to be here, mate.
Cheers.
Cheers.